You're watching the Money and Wealth Show. I'm Sterling Fox, and it's a real pleasure this week to be joined by Bob Hoye from the Institutional Advisors. Bob is the editor and chief strategist with this outfit that's been around for decades now, Bob.
Yes.
I want to talk about regulation. There are a lot of people, including the President of the United States, who are looking at the debacle we are trying to get out of and saying things like, look, if they hadn't deregulated the banks and the marketplace 10, 12 years ago, none of this would have happened. Let's get those regulations back into place as quickly as possible, and everything will be just fine.
Dream world stuff of the first order. For example, after the 1929 crash and in the early 1930s, those in government and those in the investment business knew that the bust was due to the boom. So then they came up with the security, in the States, best to talk about there because it's best to stay in the lead economy. They came up with the Securities and Exchange Commission, the SEC, and that was to prevent another big boom. They also came up with Glass-Steagall Act, which was to prevent the commercial banks from playing in Wall Street, and that would prevent a big boom.
Right.
Then outside of government, in 1934, Graham and Dodds published their book on investments, and it showed how stupid the pension fund managers were in the 1929 boom. So the whole point of Graham and Dodds' analysis was to prevent another 1929 boom. Then we should also look at the malfeasance side, where some criminal activities were discovered. For example, the Bernie Madoff Ponzi scheme.
Sure.
Okay. In the 1930s, when they were moving the bill along for the SEC, one of the politicians promoting it said that beyond preventing a bubble, it will put a cop at the corner of Broad and Wall Street for the guys who do things bad. Then, of course, you had this boom, and about 7 or 8 years before they discovered the Ponzi scheme that Madoff carried on, there was a whistleblower went to the SEC and said, what this guy is doing is impossible, look into it. The SEC didn't look into it. So by that definition, the SEC was a failure. It did not prevent another 1929 bubble, and it did not prevent the malfeasance that goes with a bubble. So then we want to step to the Glass-Steagall Act, which separated
The banking activities.
banking
Right.
activities
Okay.
from playing in Wall Street.
Sure.
But then all the banks, it was so much fun, they had to play in Wall Street. So then the Glass-Steagall was taken off the books. But it's happened before. In 1720, the House of Commons in England passed an anti-bubble act. Guess when they took it off the books? In 1772, just in time for the next big freaking bubble. So they do the same things each time.
So you're saying that bubbles are inevitable just
Yeah.
as a consequence, a byproduct of the capitalist system, for lack of a better term.
It's part of the markets. And you have a record of huge speculations going all the way back to Roman times. They might have been in mortgage securities then. And you also have an example of governments responding to the hard crash by coming out with New Deal things. There is a book called The New Deal in Old Rome, and they did it all. They did everything that Roosevelt did, and then policymakers this time around are doing the same things. More assistance to this, more assistance to that. So there's nothing new in the financial markets
But back
at
to,
all.
back to the regulatory aspect of the conversation, Bob, and speak to those people who are convinced that if we initiate and create a stronger regulatory playing field, then this sort of Wild West show that created the current malaise will not be permissible.
Right. But that's not the case. It just, as a major banker in England in the 1840s said, and I haven't got it perfectly memorized, but there's nothing you can do to prevent a public from suddenly wanting to grow rich. So it happens. Even tulip bulbs in 1637 was the public suddenly wanting to grow rich. So there's nothing you can do. And even on the tulip bulbs, the authorities then in Amsterdam, which was the center of the commercial and financial world,
Definitely.
said that those bulbs are they're not defendable contracts. So, and now you have all the derivatives you hear about. Those are, you can't hold those contracts secure. So you can't change human nature. But then you cannot change those who, after a bust, say that you've got to slam all the barn doors shut.
Right.
Because after every one of those previous 5 bubbles, the authorities have come in with measures to prevent another bubble. Then 50, 60, or 70 years later, there'll be another one. Mm-hmm. So it's the way it works. And the interesting thing, Sterling, is that the textbooks, all the interventionist textbooks, have been based on no history whatsoever. It's been based essentially on the idea that a power can manage people. And then that power then gets to be able to invent credit out of thin air. So you'll find that in each of the bubbles, government agencies, regulations, will favor a boom. Then once the boom is over and you're in the contraction, the government apparatus shifts over to, as I said, slamming barn doors shut after the horse is gone.
Exactly.
Yeah.
Our guest is Bob Hoye from the Institutional Advisors, and the historical perspective that he brings to this program and to the economy. And we've got lots more coming right up.
Hi, I'm Larry Ray, Chairman and CEO of Molycorp Gold Corporation, a company focusing on specialty metals, gold, copper, and platinum palladium. Currently, our focus is in Nevada, where we made a serendipity discovery of magnesium a couple of years ago. The 43101 report indicates that we have 52 billion pounds. It's wide open. With more drilling, we could probably double that. Magnesium currently trades at $1.20 a pound. We also have other gold properties in Nevada, especially the Davis property, which has a historical resource on it. In British Columbia, Molycorp made a discovery of high-grade molybdenum along with its sister company, Gold Ray Resources Corporation. The deposit is open on both ends. There's a 43101 resource study on it, and it could make a very nice small, decent grade producer in the future. Molycorp trades on the Toronto Stock Exchange Venture under ticker symbol MOR. If you would like more information on us, visit us at our site molycorp.com or phone us 604-531-9639.